This is Benjamin Alley with Alley Law. This session we're going to discuss choosing or changing your business entity. Let's take a look at your choices for business entity. This list may seem overwhelming to you, so let's try to break it down into something more manageable. For most business owners, the relevant categories are a sole proprietorship, a general partnership, a limited liability company, and then two versions of the corporation, the S-Corp and the C-Corp. There are four main questions to consider when choosing between these entities. How much formality can you tolerate? How much personal liability can you risk? Which entity will minimize your taxes the most? And where will you get the money to fund this business? First, let's deal with the question of formality, or how much do you want the government to place legal requirements on the business? The best way to evaluate the formality differences between the entities is to think about it as a continuum. Entities on the left side of the continuum have fewer formalities required by the government, while entities on the right side have more formalities. For example, sole proprietorships and partnerships have no government requirements to set them up. By contrast, S-Corps and C-Corps have government requirements in setting up the corporation, running the corporation, and terminating the corporation. One key question in determining the appropriate level of formality is how diverse is your ownership? If you or only a few people are involved in this business venture, you may feel more comfortable with an entity with less formality. However, if there are many owners/investors with diverse backgrounds involved, more formality may be needed to ensure the business is run properly and fairly for all owners. The second question to consider is how much personal liability can you risk? Or how willing are you to personally pay the bill for the business's debts and obligations? Imagine that the dotted line around the owner represents either a sole proprietorship or a partnership. With these entity structures, the liabilities of the business pass directly to the owner. In other words, if there is not enough money in the business bank account to pay the business's bills, the owner will have to pay those bills out of his own pocket. Therefore, your personal liability under both a sole proprietorship and a general partnership is high. Now, it should be noted that there are ways to limit your liability under a partnership, but an explanation of those details is beyond the scope of this video. Now imagine that a solid black line surrounds the owner, and this line represents an LLC, an S-Corp, or a C-Corp. These entity structures protect the owner from being personally liable for the debts and obligations of the business. In other words, if the business bank account does not have enough money to pay its bills, the owners cannot be forced to pay those bills out of their own pocket. Therefore, your personal liability under an LLC, S-Corp, and C-Corp is low. However, if there is evidence of fraud, unfairness, or the business has not sufficiently observed those formalities that we discussed previously, the court can break through this entity protection and still hold the owners of the business personally liable. One key question in determining the amount of entity protection you need is whether buying insurance can mitigate the risk you will face in your business. If the answer to this question is yes, then you may be able to use an entity structure towards the left that provides less protection. If the answer is no, then you may have to choose an entity structure towards the right that provides more protection. The third question is which entity will minimize your taxes the most? Imagine that the dotted line above the owner represents either a sole proprietorship, partnership, LLC, or S-Corp. These entities allow the income and loss of the business to pass through the business and go straight to the owner. The owner then pays income tax to the government. Therefore, the income of the business is only taxed once at the owner level. In addition, the owner can use the losses of the business to offset other income she may have from other sources. Thus, she can lower the total amount of tax she has to pay to the government. Now imagine that there is a solid black line above the owner that represents a C-Corp. When income comes into the business, that income is stopped at the business level. The C-Corp pays tax on this income. The income is then distributed to owners through dividends and is taxed at the owner level. Therefore, the income of the business is taxed twice, once at the corporate level and once at the owner level. Now, there are ways to lessen the impact of this double taxation, but those details are beyond the scope of this video. Which tax option is best for you? Well, it depends upon the specifics of your business. I suggest that you or your accountant crunch the numbers to see which entity will provide you with the most tax savings. The last question to consider is where will you get the money to fund this business? If you're going to fund this business yourself or you're going to ask for money from friends and family, then one of the entity choices on the left side of the spectrum is probably sufficient. However, if you want to obtain funds from institutional investors, such as venture capitalists or private equity firms, those types of investors are typically more comfortable with an entity structure on the right side of the spectrum. These investors particularly like the C corporation because the government formalities provide more predictability and control over their investment. More than one entity structure may be right for you, and you may have to change your entity structure as your business grows and develops. In any case, thank you for joining us. Please join us again when we discuss another aspect of business law. So long.